Hello, everyone. Welcome to the final month of 2025, 1st of December. This particular day, it's been a week in which the fixed income market is getting a ton of attention for multiple reasons. For the first time in many years, we've had two corporate bonds coming into the market, one from EABL, East African Breweries, the other, of course, from Safaricom, which will be the focus of our conversation over the next hour. So here's a short version. Safaricom, biggest telco in the region, has gotten authorization from the Capital Markets Authority to come to markets and to raise 40 billion shillings in total in debt. In the first batch, right, of that medium-term notes, that bond program, the MTN that you will hear us referring to over the next hour, in the first batch of that medium-term note program, they're looking to raise at least 15 billion shillings from you, payable in 5 years, from a broad range of investors, with interest payments done twice a year, middle of June, middle of December. That's a quick and dirty version of this. But there's a lot of documentation that you will be hearing us referring to with my panel over the course of the hour, and I would certainly encourage you to please go out there, go and read that documentation in detail. Here's a starting URL, safaricom.co.ke, investor relation landing, there's a hyphen in between all those, /bond-investors. I'll repeat that again, safaricom.co.ke/investor-relation-landing /bond-investors. You'll find a ton of documentation over there, including the information memorandum, which is absolutely key. And you'll hear us referring to that in detail over the course of the hour. I'd like to introduce my panelists for this conversation. We'll be speaking to three gentlemen who have been involved in one way or another in this particular deal. We've got Gregory Oweru, who's the Chief Executive Officer of SBG Securities. Rujusan Raksha is the Managing Director and Head of CIB coverage here in Kenya at Standard Chartered. These are part of the joint lead arrangers on this particular deal. We also have Silha Rasugu, who's a Senior Analyst and Partner at Emerging and Frontier Capital. I do have Silha on the line at the moment, so I'm going to start with you, Silha. This is interesting, right? On many reasons. We finally are seeing some interesting activity coming back into the corporate bond market. Let's start with that pricing question. The bond is getting a tax exemption because of where the proceeds are going to be invested. Walk us through the legal basis for that and what makes this a quote-unquote a green bond.
Hi, Rama. Hi, everyone. Good evening. This is Silaya. I think I would rather have the arrangers speak to the legal basis of it, but broadly speaking, from my understanding, you have criteria established to consider financing as green, specifically going towards sustainable projects, whether it's energy efficiency, tackling climate change, or socioeconomic development as the use of proceeds to qualify for a green bond. I think for Safaricom's offer, what's most exciting, just from first glance, is that the interest rate is fairly favorable to the company itself. I think the timing is part of the reason for this. We've been in an easing environment from a policy standpoint on interest rates. Liquidity has improved, and I think their timing also aligns with getting to or near commercial viability in Ethiopia, where risk would be considered higher and might have had an impact on the pricing of the offer. But I think that's what I think qualifies for a green bond, and I would let some of the other panelists expound on that more specifically.
Indeed. We'd started the conversation there with Silla, focusing on the legal basis, right, for making this a green bond. And I know that's going to lead us into the conversation around pricing. But from your role as part of the lead arrangers for this offer, walk us through the rationale here. Why is this a green bond? What's the legal basis for it?
So two broad angles. One is Kenya has, through the NSE and CMA, issued green bond guidelines and standards, which are well documented. And they lay out principles under which green bond can be issued. And primarily they have to be environmental and then measured. And then from a capital markets perspective, there is the international capital markets principles for green issuances that this bond has to conform to, because we didn't just look at it as a domestic transaction. In the future, Safaricom or any other corporate may want to go offshore using very similar structures. So we wanted it to meet international standards as well, so that if international investors wanted to come in, they could. That was the initial thinking. And also, National Treasury has a green bond sovereign framework, which also conforms to ICMA, and therefore this aligns with that as well. So we looked at it in multiple ways. As I said, one is CMA NSE guidelines and standards. The second one is ICMA, which it adheres to.
With respect to the overall medium-term program, the approval allows Safaricom to borrow up to 40 billion shillings in total. The initial tranche, however, is only for 15 billion. And looking at the performance of auctions on the government bond side of things over the last quarter, especially the second half of 2025, there's been a lot of liquidity coming into the market. So why structure it this way and only come in for that initial tranche of 15 billion when we've seen auctions where the market has come in with bids of 30, 40 billion shillings? And granted, it's not a straight apples to apples comparison, but if you look at what's been happening on the T-bill side, for example, like last week, government comes in for its usual 20 billion, they got over 40 billion shillings in. So there's a lot of liquidity sloshing around now. And from an outsider's perspective, I guess the question would be, if there's that much liquidity, why not snap up as much as you can now, so then part of it's for later?
A few things. One, remember this is 15 billion with a 5 billion green shoe option, which means they can up to 20 billion should it be oversubscribed. The second one is the cost of interest. Once you raise the money, and assuming they took the full 40, Safaricom would be on the hook for paying interest on the full 40 from day one. They then have to make sure that they have the ability to deploy the funds into the green projects as outlined in the documentation quickly. You don't want to be sitting on funds in current accounts or fixed deposits. It just costs money. So it was structured as a program to take into account, one, the cost of carry, the cost of interest that Safaricom would bear, and two, the ability to absorb the funds into the eligible green projects that they've outlined. That said, we saw EABL go above, take the full 16 or 16 and a half or that they raised. Safaricom, as I said, has a green shoe option for another 5, so 15 plus 5. And we'll see how the bond performs once it closes.
We've also been joined by Gregor Herrero, the Chief Executive Officer at SPG Securities. Greg, let's clarify the conversation around pricing, because based on the chatter that I've seen online, I see quite a few people looking at that coupon rate of 10.4%, and the immediate reaction is to compare it to what they're getting or what they could potentially get on the government bond side. And again, not a straight apples to apples comparison, but could you walk us through how that 10.4% coupon rate was arrived at, and how potential investors should be thinking about, at least on the retail side, when comparing it to alternatives in the fixed income market?
Yes, absolutely. Thanks, Rama. I think it's an interesting debate, but I think several things come to mind when you're discussing pricing. Several things go into that price determination, and I understand the tendency to try and compare that with what they're getting in government security. But I think it's a more nuanced conversation because this is a corporate bond. There are different things that come into play when you're trying to think about how to price corporate risk, and especially for a high quality issuer that you'd have in Safaricom. There is also the reality of it is that Safaricom has not been in the debt capital markets for a long time. I think the last bond was, 2010, more than 15 years ago. So I think one could also argue there is some inherent scarcity value that you've got in such a high quality corporate coming to market. And as you can see, the full notional amount of the program is 40 billion. So the amount of money they're coming to borrow into the market is finite. I think they have a clear, and this is also the reality, is that once you've got a program in place, it actually promotes also what you would say is a better discipline from an issuer point of view. What you've seen is that on day one, I think there was a question around why not take the full 40, but I think the reality is that the company will only take the money that they need and not apply the entire amount in one single issuer. So there's also that issue to also consider, as well as ensuring there's a careful balance between the cost that is efficient for the issuer and what investors are prepared to earn in order to invest in the program. So I think there's a lot of things that as arrangers we ideally would need to manage, including also understanding where the pockets of liquidity are, the market conditions today. I think when you look at the interest rate cycle, we are at multi-year lows. So that's one of the factors that we would factor into that price discovery process.
Gentlemen, I want to pull back a little bit away from the Safaricom bond program itself and just look at the broader bond market in the country, as it were, the second half of 2025, because we're seeing a lot of liquidity coming into markets, and especially on if I just use the 364-day note as a proxy for how the market has been behaving. Over the last 2 quarters, we've been seeing consistently, more or less, a lot of oversubscription on that particular note. Last week, for example, 10 billion, which is what the government was asking for on the 20th of November. They got 25 billion in bids. And last week, again, asking for 10 billion. They got 26 billion. I go all the way back to 30th October. Government comes in, looks for 10 billion. They get over 20 billion in bids. Where is this liquidity coming from at the moment? What is it that's making this attraction for fixed income so strong at the moment in a year when even the stock market has been on an interesting rebound? The NSE 20 is up over 30%. Greg, do you want to take that?
Yes, and I don't know whether it's a single path issue. I think there's a lot that one has to look at in assessing the liquidity conditions. I think the one issue we have today is that, if, for example, when you look at the RBA, the pension fund industry, a majority of it is actually in government securities. So I think one of the other arguments one could make is that this liquidity is there, yes, because one, I think there is some improved contributions from that industry. I think that's something that has developed over time. I think the other reasons why liquidity in the market also because essentially there's also limited investment universe outside government securities. There's been quite some level of concentration that we've seen across different investor categories in Kenya, and I think particularly in the pension fund industry. So I think that's one way also to look at it. I think it's a much broader issue in order to really unpack the source of the liquidity, but I think those are some of the elements that come to mind.
Anyone want to weigh in on that, on where the liquidity is at the moment to the fixed income market? Because there's been a lot of activity in there, but looking at it, I'm always curious, where's this money coming from? Is it all domestic? Is some of it coming from offshore?
No, our local sort of government security book is 96% domestic. And if anything, you look at traditionally the banks, I think we've talked about the pension funds, asset management community. The banks have primarily been investing in government securities, and that's continued to rise, whether you look at it as a percentage of regional peers, etc. You've seen until sort of H2 this year, private sector credit has been contracting or was contracting. It's now going up again, but that liquidity has to be parked somewhere. And then between the 1 year and then if you look at 7 year, there's really nothing available in the government security space or on the primary. You can look from secondary, but on the primary, 1 year is where it maxes out. And then the next thing is you have 7 year plus paper. So everyone who's got liquidity is playing on the maximum tenor they can find on the short end, which is 1 year. And then those who want to go 7 year plus are going, which is why paper of this nature, which is sitting at the 5 years, is sweet spotted. As Greg has talked about, it's a very nuanced approach to determining tenor and price on such a transaction. But Rama, going back to your point, we also see a huge amount of liquidity sitting in the Kenyan banking system, start looking for a home, whether it's private sector credit or government security.
Sila, do you want to weigh in before I get to one of the questions that we're seeing coming through from our listeners?
Sure. My fellow panelists have really touched on the domestic side and the inclination that a lot of the fund managers have towards bonds. And I think it's also reflected in the market. If you look at the product offered by fund managers, a lot of them are capital preservation. And that asset under management has been increasing, especially over the last 12 months. So I think there's an inclination towards bonds, and AUMs are actually growing domestically. I think for foreign capital, there's some stability on the currency side. And as Greg mentioned, the interest rate cycle, I think, is in favor of the debt side. Yield not too high, but there's still a good spread. You're a portfolio investor moving dollars into frontier markets like Kenya. There's still favorable yields relative on that front as well to have a carry trade. And at the same time, there's been some relative stability on the domestic side from interest rates, inflation, and currency perspective that makes that a bit slightly more attractive than in previous years.
See, the questions are now starting to come in at the moment. There's an interesting one that's come up from 254 for Life. I'm not sure if this is a man or a woman, but he or she's asking, quote, should possible investors consider reviewing the initial IPO performance of Safaricom share prices? More specifically, should they be concerned about why a company that's considered to be successful is coming to the market and seeking debt funding? I can give you a bit of a short plug to this because the Safaricom CFO did actually explain that he thinks that the company's funding structure does need to change. But I'm going to let the panelists, start with Phil, if you want to take on that. I'll let them explain why even a firm of Safaricom size would still have a case to make for coming into the corporate bond market.
I think there's always a necessity to have an efficient capital structure. Equity is more expensive than debt, ideally. So the risk premium on that is much higher, and it would cost more for a Safaricom if they needed to raise debt or equity. If you look at the company performance and trajectory, it's surprisingly still in a high capex cycle. And that's driven by Ethiopia, but Kenya as well. There's infrastructure upgrades, the transition from 4G to 5G, and the need to increase the fiber network and associated infrastructure, including data centers. So I think it's an efficiency question from the company's perspective. How best can they allocate capital and ensure returns for shareholders? So I think the timing tells us a lot about why they would want to go into the market for debt and the position they are in their capital investment cycle as well, which has been quite aggressive since they expanded into Ethiopia.
I think Silha has touched on the capital structure issue, which is important because debt is an important funding mechanism for company, whether it's for working capital or other short-term funding requirements, or whether it's more long-term term debt to fund more strategic longer-term projects. I think investors then, particularly for bond investors, they need to then assess the credits story for the issuer, and I think the way to do that is to look at the disclosures in the information memorandum, which then provide additional disclosures around a use of proceeds, what that money is being used for. I think in this case, it's particularly being a green note. I think investors then should take a cognizance of that fact. So I think it's really about assessing the credit history of a company, and I think equity investors also have a different lens somewhat for looking at the company, but I think both then need to look at the overall profile indebtedness of the company, its debt profile, and the other sort of metrics they would use to evaluate whether the company is in good credit standing or otherwise.
I liken telcos to airports. If you ever land at any airport in the world, there'll always be some construction work going on. It's a permanent construction. Telcos and technology companies are permanent investment trusts. They're constantly raising debt or equity. In Safaricom's case, they have primarily been funded by short-term debt in Kenya. It makes absolute sense for them to, as Greg said, get some long-term debt onto their balance sheet at fixed rates, because then it gives them a hedge between floating and fixed. In any case, today when you look at Safaricom's debt to equity, they do need debt from the balance sheet to continue expanding and growing. And just for clarity, and I'm just quoting what the Safaricom CFO said last week, the use of proceeds primarily in Kenya, none of the proceeds are going to be used for Ethiopia. Just quoting what the CFO said.
That's an important point that you raised, because I know that's again one of the things that I've seen coming up in conversations over and over again. I want to come to a question that I had, but also I'm seeing from the audience here. Eric Mukai is asking, with respect to timing, because I think this time last year, again, just using the public side of the fixed income market as a reference point, this time last year, the 364-day note was around 13-14%. We've come all the way down to around 9.3, 9.4%. So from a timing perspective, I would look at what's happening on the yield curve and say, this looks like an interesting time, or rather the ideal time to lock in rates now that we're essentially more or less at the bottom of the cycle, I would say. But from your perspective as leader rangers, Raju, was that the main driver for issuing now for the timing of this issuance, or are there other factors that came into play?
So Safaricom last year, the year before, raised 3 billion shillings of the sustainability link. So this is the syndicated loan market. And every year Safaricom does raise debt in the bank market. There's a press release. This made absolute sense because the nature of that debt, again, it's not short term, but it amortizes pretty quickly. So it amortizes every 6 months or 1 year, as the case may be. This gives them a bullet payment at the end of 5 years. From a timing perspective, our view is Safaricom would have come to the market, as they do every year, some sort of debt rate. The interest rates made a lot of sense from them from a cost perspective. And as you said, the view was we're toward the end, the bottom of the cycle. It just made absolute sense. So what I'm trying to say is Safaricom would have raised debt one way or the other under their continued investments. It just so happened that the market timing right.
One of the interesting things are looking at Safaricom's stated use of proceeds. There's a whole bunch of specific things that they say they want to invest their proceeds in. And a lot of them, of course, are related to infrastructure investments into the fiber network and also improvements on the cell towers. And that includes putting up solar panels and batteries across 5,000 different cell tower sites. And so my question to you, Greg, is on paper, at least as an outsider, I look at that and they say, this looks like a prime opportunity for vendor financing. Why was that option not ideal compared to coming to the market and raising money through a medium-term note?
I guess you're alluding for, the vendors to be funded rather than the company, Safaricom itself. I hope I've understood that's the basis of your question.
Because I imagine there's all these battery suppliers, solar PV suppliers based in China, who would probably be happy to say, if Safaricom needs an order of X amount across these many sites, we can probably organize yuan financing or euro financing or dollar financing at 5%, 6%, whatever the number might be, to fund the purchase of the hardware that's needed across these sites. That could have happened. How does that deal compare to coming into the market and saying, we're going to raise $150 million in the local markets and then pay for that ourselves?
No, I think it's a much broader issue, Rahman, because Safaricom has a capex a plan that it put out there, and this is money that either will go directly into financing or refinancing qualifying projects that would then be on the balance sheet. So I think being an issuer, you've got to think about what also makes sense from what is the most optimal way to fund yourself. And this is money that they spend themselves. I think, yes, there is a question about vendors, but I think there are probably other arrangements for that. But if you think about also the quantum of the funding being raised, I think it would also be not the most efficient if that was the case. But I think the main issue here, Rama, is what the company already needs to spend or has already spent in funding the set out projects as per the information memorandum and also as per the sustainability framework that has been provided.
Just looking at the use of proceeds, it looks very broad, so to speak. So perhaps there's multiple vendors in this context, and also the vendor financing ties you into a specific vendor. Yet, especially on the technology side, there may be developments over the next 5 years where the company would want that flexibility to simply get the best vendor for a specific project, and the cost element might be relatively comparable in that scenario. So I think that when sort of the path is quite straightforward, for example, just building towers or adding solar and battery backup, then vendor financing would be applicable because they're not just focusing on one area for expansion in this context. And the rate of change of technology development, I think that flexibility to get the best product and plan long-term is to their benefit, to Safaricom's benefit.
It was what the military planners and the military scholars among, so to say, they'd call that having freedom of maneuver. A couple of more questions coming in from the audience. Kizana Maridandi is essentially asking, and I believe this is directed to you, Birju, how does Stanchart then ensure that the framework and the monitoring mechanisms for this $15 billion note are robust enough to guarantee that the proceeds actually deliver measurable environmental impact? Or to put it even more bluntly, yes, we've lent Safaricom 15 billion shillings. How do we know this money is actually going to go into this green investments that the company says it wants to make?
Let me just talk about the company itself and also how we went about coming up with the framework. So as part of the bond issuance, Safaricom has issued Sustainable Finance Framework, which is available on their site, and as part of the bond documentation. In it, it highlights use of proceeds, how they will be measured, amongst other things. We help them develop that. And then as part of that, we get a second party opinion. So this is a third party, it's called a second party opinion, but effectively a third party who comes in, looks at the framework, looks at what Safaricom has been doing, interviews staff, and goes through the evaluation and monitoring mechanisms, and then issues an opinion. So we've issued that document as well by Sustainalytics. It's called the second party opinion, SPO. It's on the site as well. Now, coming to the issuer itself, Safaricom has been issuing a sustainable business report for 14 years. So they were doing sustainability before sustainability was a thing. And over the years, they've continued to develop the mechanism of how they measure these, whether it's science-based initiatives as SBTI, the true value measurement criteria. And what they're saying effectively is, and they publish it every year, they did the last one in October this year, they said, here, have a look at it and challenges if you think otherwise. In this particular instance, the use of proceeds, Safaricom has to submit a report on use of proceeds until the proceeds are fully allocated, i.e., if they raise 15 billion now, they will have to issue reporting until the funds are fully allocated and then to the project that they have determined, and that will also be declared. And then as part of the annual sustainable business report that they issue, there will be measurement criteria in there as well. When you think about transparent companies, I would probably put Safaricom as the leader in transparency. So they say they're purpose-led and are prepared to be measured against those criteria and be challenged. So they're very transparent. They've been doing this for a long time.
Silla, there's a question here for you, although I think I also want Greg to weigh in on this if he can. is there any potential impact on the company's dividend policy? To reiterate, just to provide a bit of context on this question, the CFO, Dilip Pal, has said quite clearly, as far as he's concerned, it's not going to have an impact on dividend policy. They're going to maintain it as it is at the moment. But Silla and then Greg, I want you to weigh in on this.
No, I don't think it has a direct impact on the near-term dividend policy or even in long-term perspective as well. I think Barju had mentioned this earlier, but a simple credit analysis on Safaricom's balance sheet, it's very unlevered. And so on our estimates, we're looking at about 0.7 times net debt to equity. Anything below 1, I would consider unlevered. Comparable telcos, for example, Airtel Africa, are about 2, slightly below 2 times in terms of net debt to EBITDA. So I think the balance sheet that Safaricom has is robust enough to take on this debt and finance the coupon payments without having to compromise on its dividend policy. And if you look at, again, in the context of the CapEx cycle, I think there's been years where those CapEx requirements were much more likely to risk the dividend policy relative to this bond issue at this time.
Greg, do you want to come in?
Yeah, although I don't think I have much more to add. So I think the reality is that the balance sheet, when you look at the debt profile of the company, there is quite some headroom for debt. And in fact, that there is this additional funding, it should also then create a better balance of use of free cash flows as well, in terms of also applying into the other purposes, for example, dividends. So I don't see this having a direct impact on the dividend policy.
Greg, I want to come back to something that you mentioned at the media briefing that we had last week, which I found quite interesting because it was a question around liquidity or the corporate bond markets. And you argued at the time, the question I believe was, we're not seeing as much liquidity in how corporate bonds are traded in the market. And your argument in response to that was that the individuals who tend to buy corporate bonds in our markets tend to buy and hold. They rarely ever come back to the market and then try and dispose of. Can you elaborate on that argument?
Yes, I think it goes back to the scarcity value that I mentioned earlier on, because when you look at institutional investors, and I think in the past what has happened is that most corporate bond issuances have been taken up by institutional investors who have found these papers to be of value from a diversification point of view. So they've not been very quick to sell because they cannot easily replace. If you also think about the number of corporate bond, high quality corporate bond issues, the reality of it is that we don't have many of those around. So this, especially from a pension fund industry point of view, where diversification has also been a thematic issue, we've not seen that appetite to sell. And sometimes we've seen buyers come and ask whether they can buy a specific paper, but on the other side of the equation, there's a limited ability to sell. But I think in the long run, we need both the government debt market and the corporate debt market to also present some liquidity opportunities for investors. And I think that's also part of the market evolution that probably needs to take place, where the corporate debt also becomes a bit more tradable and people who also buy initially can start also from time to time selling their positions in the market.
Silla, from your vantage point, is now that EABL, Safaricom have come to market, are you anticipating any extra issuance to come in first half of 2026? But corporate bond market, in other words, not a point where it's coming back to life with new issuance.
The two issuances, Safaricom and EABL, have made people and potential issuers take notice and make inquiries. We've heard, talking to clients who have gone through what Safaricom and EABL have published publicly and saying, what are the realms of possibility here right now? Now, obviously, Safaricom's pricing is very attractive, and that's what people are asking about. Can we achieve the same? Tough to say what other issuers could go with that. But fundamental view is we are seeing increased inquiries for issuances, and even for mostly first-time issuers. So there's a journey they need to walk. I think H1 2026 should be a good time for more issuers to come to market, considering we think the interest rate cycle's at the bottom. If things remain as they are, I don't think they've changed materially between now and H1 next year. Absolutely, we do see interest.
Interesting. So your views on what might happen for half of 2026? Might there be companies coming in and saying, this might look like a prime opportunity to lock in relatively low rates and refinance expensive debt we have on our books?
I think so. I think any finance department for these corporations pay attention to the interest rate cycle. And it's something that is much more favorable now than it was 2 years ago. Where I think there might be some concern is on the quality of the issuer. So these two are actually multinationals, very long history. I think when I would know the taps are open on the debt market is when we have tier two companies coming and successfully raising capital from the bond market. I think the wounds are still healing from the corporate bond failure that we've seen in Kenya, which is recent years, in the last 10 years. So I think the rate cycle plays a big role. I think companies will be paying attention, but the signal that we are likely to see more issues, I think, would come when a lower tier company successfully raises from the bond market. But I think the momentum overall is quite positive. I think on the NSE, the corporate bond market has been still, to say the least, in recent years. And the way issues that were defaulted on were resolved, perhaps if that was done better, I would be more confident in the potential for new issues or new raises next year in the first half.
And the demise of Chase Imperial and so on and so forth left quite some deep scars. But with the last point that you raised there about how those issues were resolved, do you think we're in a better place in 2025, assuming, for the sake of argument, Company X comes to the market 2-3 years down the line, it defaults? Are our legal institutions or legal frameworks in a much better place to handle something of that sort than we were, say, in 2015, 2016?
I'll give my personal view, then I should allow the other panelists to chip in, but I don't think so. I think resolution, if it wasn't central bank led, I would like to have seen much more done by the CMA in terms of addressing those issues and following through on perhaps how the investors were paid or not paid and what the conclusion was. So in my view, I don't think I've seen drastic changes from a regulatory perspective to these issues. But I could be wrong, and I think it's better when there's a second regulator in the picture, like the central bank. But I would like to see more from the capital markets to ensure investors are comfortable with issues that come to markets.
Fair point. Absolutely a fair point there. Greg, Bridget, do you want to weigh in on that question around whether we're in a better place to handle any potential defaults than we were a decade ago?
Yeah, so maybe I'll just go in quickly. Yes, I think, as you're aware, first of all, there's a new public offer listings disclosures regulations from the Capital Markets Authority that was effective end of 2023, which contained some improvements to the regulatory framework. But also, the failures of those bonds also led to more discipline in credit analysis. So investors are not just going for bonds because there is yield on the table. I think there is some level of depth that we have today that we did not have over 10 years ago.
All right, then, gentlemen, we are approaching the tail end of our conversation, and I've been reminded that there might be individuals who are listening to this who are saying, look, I can't make head or tail of conversations around corporate bond defaults or yields, etc., or bond structure. So I'd like us to give them the quick and dirty, the elementary explanation to what Safaricom's trying to do here with coming to market and borrowing this 15 billion shillings. Let's say, for the sake of argument, we're making this pitch in a chama somewhere in the middle of Rumuruti, the tea farmers there. Greg, how would you explain this issuance to them? It's essentially a case of you loan Safaricom $1 million bob, we pay you interest twice a year, and you get your $1 million bob back in 5 years' time. That's a basic idea, isn't it?
Absolutely. I think the simple way to explain it is, yes, you are invited to be a lender, essentially, to use that word, to Safaricom in a bond format that earns you semi-annual interest rate payments on 11th of December and on 11th of June every year until maturity, which will be on 11th of December 2030. So that's when you get repaid your money, unless there was an earlier repayment for this particular tranche that will be issued this month. I think investors have also seen a lot. So the structure is relatively similar to what we have in government bonds, which tend to have a similar profile, of particularly in the FXD market. So I think a lot of investors have become quite familiar with the bond market. So I think it's quite similar to what we've seen in that space.
All right, then. Gentlemen, we're on the tail end of our conversation. Any closing thoughts that you may have before we call this a day? And hopefully we've addressed the bulk of the questions that have come in from our listeners here. Greg, you want to start, and then we'll get to Scylla and Virgin.
Yes, I think we've done a good job looking at the holistic nature of the issuance. I think one thing to bear in mind is that a medium-term note program is an innovative financing is a mechanism in the structure because it allows a wide choice of instrumentation by an issuer. So I think that it needs also to be looked at from that lens and not as a company coming to the market to pick everything that they can possibly get today in the market. So I think also that's something important to remember, that there is this tranche and there will be, we don't know when yet, but there will be subsequent tranches that can be issued under the program.
Bridget, there's an interesting question here that's just come in that I want you to cover if you can. The listener is essentially saying, comparing the minimum subscription amounts here, or 10,000 shillings for the EAPL note versus 50,000 shillings for Safaricom. Their argument is that this seems like the Safaricom note is more geared to institutional investors as compared to the retail side of the market.
I wouldn't say that, because institutional investors typically do much larger quantums than that from a 50,000 shilling aligns with the minimum for government securities issuances. That was primarily aligning. As to why the 10,000, the ranges there would be able to advise, but that would have targeted retail quite well. But from our perspective, we simply aligned it to the government number 4%.
What your closing thoughts before we end our conversation?
There is a place for an instrument like this in any one sort of savings pool, to be it an institutional investor or an individual. At the top line, it does good in terms of its impact. From a green perspective, it gives very regular income and predictable income. So twice a year, as Greg talked about, at a very competitive rate and tax-free. And you've got 5 years of income coming in. So I think as people look to diversify from savings accounts, fixed deposit, money market funds, share equities, this is just one more tool in your armory of investment. And I would recommend this instrument to any investor. It is a very high quality issuer, as everybody knows, and the pricing very attractive.
Thank you.
Thank you, Rama. I think just to start with the fear of a simplification, I think 10.4% tax-free is an attractive offer. We zoom out and think about what Safaricom is doing in the context of African telcos. Debt is actually very, very much utilized to fund this heavy capital investments. So if I look at the leverage ratio for Safaricom's balance sheet, it's more of an outlier rather than the norm, in that they rarely use large amounts of long-term debt to fund their capital investments, which points towards the strength of their cash flows. And lastly, on that, I would say historically, Safaricom has been a very strong capital allocator. So just one ratio we can use to qualify that. If you look at the cash return per shilling invested, for a long time, it's over 2 times, meaning where they're putting their money is actually yielding returns from an earnings perspective. And Safaricom is still one of the higher return on invested capital companies in the telco space in Africa. So I don't see this as a concern, but it would be exciting to see them continue on the execution to keep the earnings momentum going.
Indeed. And we'll leave it there for the time being. As always, for all the people who've been listening to us over the course of the hour, again, we'd like to remind you to head out to Safaricom's website and get the bond documentation and go through that yourself. There's a ton of documentation in there from the second party opinion. There's a whole FAQ, the sustainable finance framework that we've been speaking about. So you heard me referring to Safaricom planning to invest in providing a lot more solar panel and battery card storage coverage to 5,000 different sites in Kenya. Those details are all in there. And of course, the information memorandum, it's over 200 pages, but definitely worth reading. safaricom.co.ke/investor relations/bond investors. Worthwhile reading all the information in there. As always, a big thank you to our panelists tonight. Gregory, the Chief Executive Officer, SBU Securities, Bridget Senrachta, the Managing Director and Head of CIB Coverage here in Kenya at Standard Chartered, and of course, Sila Sugu, Senior Analyst and Partner at Emerging and Frontier Capital, and of course to you for spending the last hour with us here on Mango Capital. Thank you very much.